Please stand by. Good afternoon, and welcome to the fiscal year 2027 first quarter financial results conference call for Dell Technologies, Inc. I'd like to inform all participants this call is being recorded at the request of Dell Technologies. This broadcast is the copyrighted property of Dell Technologies, Inc. Any rebroadcast of this information in whole or part without the prior written permission of Dell Technologies is prohibited. Following prepared remarks, we will conduct a question and answer session. If you have a question, simply press star, then 1 on your telephone keypad at any time during the presentation. I'd like to turn the call over to Paul France, Head of Investor Relations. Mr. France, you may begin.
Thanks, everyone, for joining us. With me today are Jeff Clarke, David Kennedy, and Tyler Johnson. Our earnings materials are available on our IR website, and I encourage you to review these materials. Also, please take some time to review the presentation, which includes additional content to complement our discussion this afternoon. During this call, unless otherwise indicated, all references to financial measures refer to non-GAAP financial measures, including non-GAAP gross margin, operating expenses, operating income, net income, diluted earnings per share, free cash flow, and adjusted free cash flow. A reconciliation of these measures to their most directly comparable GAAP measures can be found in our web deck and our press release. Growth percentages refer to year-over-year change unless otherwise specified. Statements made during this call that relate to future results and events are forward-looking statements based on current expectations. Actual results and events could differ materially from those projected due to a number of risks and uncertainties which are discussed in our web deck and our SEC filings. We assume no obligation to update our forward-looking statements. Now, I'll turn it over to Jeff.
Thanks, Paul, and thanks everyone for joining us. What a great start to FY27. The first quarter underscored the strength and agility of our operating model and the advantage of our broad portfolio. Our team executed very well in a challenging environment, delivering record revenue and EPS. Revenue was $43.8 billion, up 88%, and earnings per share was $4.86, up 214%. Demand was stronger than we anticipated across all lines of businesses and geographies, with customers moving decisively to secure supply across a broad range of IT needs. This drove meaningful scale, record cash generation, and continued strong capital returns for shareholders. Our strong performance reflects not only demand in the quarter, but also the pace of innovation we continue to bring to market across the full stack of PCs, compute, and storage. We have had a strong run of announcements since our last call. At GTC, we marked the 2-year anniversary of the Dell AI Factory with NVIDIA and extended our leadership in accelerated computing. We introduced new infrastructure across NVIDIA's Vera Rubin rack-scale platform, the Rubin GPU architecture, and RTX GPUs, with form factors that scale the AI factory from the largest clusters in the world to the flexibility and efficiencies enterprises need. We also extended AI to the desktop with the new Dell Pro Max systems, supporting the GB10 and introducing the industry's first OEM desktop with GB300. At Dell Technologies World, we built on that momentum with new desk-side, server storage, and data management innovations. Our desk-side agentic AI solutions help enterprises run production-ready AI locally, supporting use cases like coding, research, and secure private assistance while keeping sensitive data and IP on-prem. Building on strong demand of our integrated rack-scale systems, where Dell is the top rack-scale infrastructure provider, we expanded the portfolio with the launch of Dell PowerRack, a turnkey factory-integrated solution designed to accelerate deployment across compute, networking, and storage. In servers, our 18th generation of PowerEdge server portfolio expands support for AI, HPC, and enterprise workloads, with new air-cooled systems that improve compute density and efficiency. On the data side, advancements in the Dell AI Data Platform help customers make enterprise data ready at scale with stronger orchestration, faster indexing of unstructured data, and improved analytics performance. We further strengthened the storage foundation for modern and AI workloads, PowerStore Elite delivers up to 3x performance and density than prior generations with an industry-leading 6-to-1 data reduction guarantee. Object Scale adds higher density object storage, and PowerFlex extends our exascale storage architecture with a unified approach across block, file, and object workloads. We continue to expand the Dell AI Factory ecosystem with partners including NVIDIA, Google Cloud, OpenAI, SpaceX AI, ServiceNow, Palantir, Mistral, and CrowdStrike. For example, with Google Distributed Cloud, we are bringing Gemini models on-premises with confidential compute so customers can run AI closer to the data while meeting data residency, privacy, and sovereignty requirements. The bottom line, Dell is expanding the AI Factory from the data center to the desk side across compute, storage, networking, software, and services. We're giving customers choice, helping them protect their data, and enabling them to move from pilots to production faster. With that context, let me walk you through what we're seeing in the business. Our Q1 results. In AI, the opportunity remains exceptionally strong, underscored by durable, broad-based demand. In Q1, we booked $24.4 billion in AI orders and recognized $16.1 billion of AI server revenue. We exited the quarter with a record $51.3 billion of AI backlog, and our pipeline continued to grow sequentially and remains multiples of our backlog, even after converting $24.4 billion into orders. Demand continues to exceed supply, with memory as the primary constraint, and we expect to exit the year with meaningful backlog. Our customer count surpassed 5,000 with growth across neocloud, sovereigns, and enterprise customers. Our differentiated offering continues to resonate, and our expanding platforms and capabilities are supporting continued share gain. We believe those share gains are rooted in things that have long differentiated Dell: strong engineering and design, the ability to deploy and install at scale, ongoing services and support, and flexibility, financing, and consumption options. In AI, those advantages matter even more. Customers are not just buying components. They are looking for integrated solutions they can put into production quickly on infrastructure they control with the performance, security, and data foundation their workloads require. Moving to traditional servers, revenue is up 92% as demand remained well ahead of supply in Q1 with strength across every region. The majority of demand was driven by large enterprise customers refreshing their compute environments and expanding capacities to support growing workloads. For many large customers, ensuring compute availability to modernize and grow remains their highest priority. Customers are also increasingly focused on infrastructure density as they optimize both spend and data center space, which is driving demand in platforms that deliver more compute capacity, greater efficiency, and better consolidation within existing footprints. Additionally, we saw AI inference workloads driving incremental demand for traditional compute. The majority of the installed base remains on 14th generation or older servers, reflecting the continued refresh opportunity going forward. The memory uncertainty is driving customers to proactively secure access to infrastructure across both traditional and AI workloads over longer periods of time. We also continued to execute the pricing and margin discipline we established in Q4. All in, we remain confident in the demand outlook for traditional servers, and our portfolio is well positioned to capture that opportunity. Turning to storage, revenue was up 8%, driven by continued outperformance in our Dell IP portfolio. Dell IP delivered a record demand growth quarter, making our fifth consecutive quarter of demand growth above market. In primary storage, we saw notable strength in PowerMax and PowerStore. We continue to see momentum in the mid-range ecosystem, with PowerStore delivering its eighth consecutive quarter of double-digit demand growth. In unstructured, we saw strong performance from PowerScale and ObjectScale, with 3 consecutive quarters of growth, including double-digit in each of the last 2 quarters. Dell IP storage continues to become a larger mix of Dell storage with its higher margins, and as a result, storage delivered strong profitability and was a key driver of overall ISG profitability in Q1. Turning to CSG, revenue grew 17%, and we gained share for the second consecutive quarter with broad-based demand led by large enterprise customers. Commercial revenue grew 18%, our seventh consecutive quarter of growth, with demand up for the ninth quarter. Large enterprise customers continue to refresh with double-digit growth across all regions. We continue to see run rate in the refresh cycle with roughly one-third of the install base consisting of devices 4 years or older. Consumer revenue is up 9%, our third consecutive quarter of demand growth, supported by continued strength in gaming. Overall, CSG profitability improved as better expected demand drove higher attach, greater scale, along with improved consumer profitability. In closing, Q1 was a strong start to FY27 and another proof point in the power of our operating model. We delivered record revenue, EPS, and cash flow and continued returning capital to shareholders while executing with discipline in a challenging demand and supply environment with notable commodity constraints, particularly in DRAM and NAND. Customers have come to rely on Dell during periods of significant disruption, and we expect that to continue over the course of the year. Our customers are investing in AI infrastructure, modernizing compute, expanding storage, and refreshing PCs to support the next wave of workloads. We are well positioned with our portfolio. I am proud of the team's execution and confident in our ability to create long-term value for customers and shareholders. With that, let me turn it over to David to walk through the financials and our outlook.
Thanks, Jeff. We delivered a record first quarter, which positions us very well for the year. Execution was strong across the business, from supply chain to sales to pricing, driving record revenue, EPS, and cash flow, along with continued strong shareholder returns. Total revenue was up 88% to $43.8 billion. Gross margin dollars grew 57% to $7.9 billion. Gross margin rate was 18.1%, driven primarily by mix shift to AI servers, with AI revenue up nearly 9x year over year. Excluding the impact of AI mix, gross margin rate was up. Operating expenses were up 9% to $3.7 billion, primarily from variable compensation tied to our outperformance. Importantly, we drove meaningful scale in the P&L, with OpEx down 610 basis points to 8.4% of revenue, the lowest level in over 20 years. Operating income grew 154% to $4.2 billion, or 9.7% of revenue, driven by higher revenue and resilient margins across traditional servers, storage, and CSG. Net income was up 194% to $3.2 billion, primarily driven by strong operating income. Diluted EPS increased 214% to $4.86, a record. Moving to ISG. ISG revenue was a record $29 billion, up 181%, marking 9 consecutive quarters of double-digit or better revenue growth. AI server momentum remained very strong. In the quarter, we generated $24.4 billion in orders, $16.1 billion in revenue, and ending backlog of $51.3 billion. Traditional server and networking revenue was $8.5 billion, up 92%, and demand continues to outpace supply. Storage revenue was $4.3 billion, up 8%, with strong demand across the Dell IP portfolio. Execution across the Dell IP portfolio was strong, with another quarter of growth above the market. Unstructured solutions were the fastest growing, along with strong demand across primary storage. ISG operating income was a record $3.1 billion, up 206%, marking 8 consecutive quarters of double-digit or better growth, primarily driven by higher revenue across the business. Operating margin was 10.5%, up 80 basis points, even as AI servers grew nearly 800% year over year. Looking at the key drivers of margin performance, storage profitability was up, with a higher mix of Dell IP and rate expansion within the solutions. Traditional server margins remained stable despite a high inflationary environment. AI server profitability was in line with our mid-single-digit operating income rate target. Taken together, these factors, along with stronger than expected revenue, drove meaningful scale in the P&L. Turning to CSG. CSG revenue was up 17% to $14.6 billion. Commercial revenue grew for the seventh consecutive quarter, up 18% to $13 billion, while consumer revenue increased 9% to $1.6 billion. CSG operating income was $1.2 billion, or 8% of revenue. This performance was driven by stronger commercial revenue and mix, which supported more higher margin peripherals, and similar to ISG, this all drove meaningful scale in the P&L. Looking ahead, we will continue to balance customer demand with supply while driving scale across the business. Moving to cash and the balance sheet, we delivered a Q1 record cash quarter with cash flow from operations of $4.1 billion. This was primarily driven by sequential revenue growth and higher profitability. We ended the quarter with $14.1 billion in cash and investments, up $0.8 billion sequentially. Our core leverage ratio is at 1.2x. We returned $2.1 billion to shareholders this quarter, including repurchasing 11 million shares at an average price of $147 per share and paying a dividend of approximately 63 cents per share. Repurchase activity remains strong, and we remain committed to our shareholder return framework. Turning to guidance, customers continue to prioritize their IT infrastructure needs with an increased focus on securing supply. We expect that behavior to continue throughout the year. For Q2, our revenue outlook is similar to Q1's performance. At the same time, we have increased our expectations for the second half while maintaining an appropriate level of prudence, given that we are only 90 days into the fiscal year. From a profitability standpoint, the pricing discipline and margin stability we saw in Q4 and Q1 continue to hold. Excluding the impact of AI mix, our gross margin outlook is better than it was 90 days ago, and we continue to expect margin rate expansion through the balance of the year. For Q2, we expect revenue of $44 billion to $45 billion, up roughly 50% at the midpoint of $44.5 billion. ISG is expected to grow roughly 75%, supported by $15.5 billion in AI server revenue, and CSG is expected to be up roughly 20%. Operating expenses are expected to be down low single digits sequentially. Operating income is expected to grow roughly 80%. We expect sequential improvement in ISG operating income rate, while CSG operating income rates moderates to roughly 6% as we balance demand, share, and profitability. We anticipate a diluted share count of roughly 652 million shares. Diluted non-GAAP earnings per share is expected to be $4.80, plus or minus 10 cents, up over 100% at the midpoint. For the full year, we expect revenue of $165 billion to $169 billion, up nearly 50% at the midpoint of $167 billion. ISG is expected to grow roughly 80%, driven by $60 billion of AI server revenue at the midpoint, or approximately 2.4x year over year. Traditional servers expect to grow just over 60%, storage up mid-single digits, and CSG to grow low teens. We continue to prioritize margin rate expansion. Excluding the impact of AI mix, our gross margin outlook is higher than it was 90 days ago and remains up year over year. We expect operating expense dollars to be up high single digits, driven primarily by variable compensation. At the same time, our modernization efforts are paying off, simplifying, standardizing, automating, and enhancing our operating model with AI, delivering significant operating leverage with OpEx as a percentage of revenue in the single digits. Operating income is expected to grow over 55%, with improvement both in dollars and as a percentage of revenue. I&O is expected to be between $1.4 billion and $1.5 billion. Diluted non-GAAP earnings per share is expected to be $17.90, plus or minus 25 cents, up roughly 75% at the midpoint. In closing, we delivered an exceptional first quarter with record performance across revenue, EPS, and cash flow. Revenue was $43.8 billion, up 88%. EPS grew 214% to $4.86. We generated $4.1 billion in cash and returned $2.1 billion to shareholders. The strength of the quarter reflects broad-based execution across the business, continued momentum in AI, and solid performance across the rest of the business. Our portfolio and operating model continue to differentiate us in a dynamic supply environment, and we remain focused on supporting customers while driving shareholder value. We are well positioned for the year. Thank you to the team for their strong execution, and thank you all for your time. Now I'll turn it back to Paul to begin Q&A.
Let's get to Q&A. In order to ensure we get to as many of you as possible, please ask one concise question. Let's go to the first question.
Thank you. We'll take our first question with Ben Reitzes with Melius Research.
Well, let me say congratulations, guys. I don't think I've ever seen a Dell quarter like this. Maybe Michael had one in the dorm room or something, beating expectations. But congrats to you guys. The question that I have is with regard to the inherent level of real demand. When you see something like this, you think like there could be some pull forward, especially in the traditional servers and the PCs. But the way you guided for the year, obviously, by taking up the second half, would imply that the pull forward doesn't have much of an impact stealing from the rest of the year. Can you just go through the puts and takes of the pull forwards in the major segments, please, and how you came up with still a higher second half? Thanks.
Sure. And thank you, Ben. It was a good quarter. Been here a long time. It's a good quarter. And when we look at the demand environment that we are operating in today, it's very different than historical. We think of it as several factors that are driving demand. Clearly, what you said, there is a pull-in component. There's a buy-ahead. Customers want to ensure they have access to supply. They're concerned about raising prices, and they're acting. There's also a component of we have large install bases, whether that be in PCs, where you have a third of the units that are 4 years or older. We were lagging in a Windows 11 refresh and caught up through the quarter against historical refreshes. And we have a large number of 14G servers in the install base that need to be upgraded as customers are moving to modernize. Customers are upgrading their edge. They're upgrading the infrastructure. They're looking for more capable PCs as agentic workloads make their way to the edge. They're looking to consolidate space, power, and cooling to drive efficiency. Our new 18G servers are a great vehicle to do that with its 13-to-1 consolidation. And we're seeing pockets of fundamental new demand. There's new demand driven by AI. There's an AI drag. There's inference. And the agentic AI is driving a new marketplace for traditional servers that we haven't seen before. And then I think the last two tend to come to Dell to look for a calming hand, looking for help. And we're certainly helping as many customers as we have. That's in PCs. That's in servers. That's in storage. So those are the demand levers of the demand dynamics that we see across all of the businesses. As we look at our forward-looking pipelines, the pipelines have never been healthier. They're actually growing at greater than historical rates, which gave us confidence to raise the guide by $27 billion of revenue for the year. I hope that helps.
Thanks, Ben.
Yeah, thanks, Jeff.
And the next question will come from Mark Newman with Bernstein.
Hi, thanks for taking my question, and congrats on a great quarter. It would be great to get a bit more clarity on the breakout of growth between units and pricing, particularly for the blowout performance you had on traditional servers. And just like adding to some of the stuff you said in the previous question, just trying to get a better sense for how much confidence you have that this is sustainable beyond just 1 or 2 quarters, but through this year and into next year. Thanks very much, and congrats again.
Thanks, Mark. Very specifically, we grew units in PCs. The last reported quarter, we grew units in consumer PCs and commercial PCs, and obviously the aggregate market. We took share. So there's a baseline of growth there. We were already the industry leader in PC revenue, and clearly the inflationary environment has driven up prices. And where we saw that primarily is on high price band products. And we were the market leader in high price band in PCs, and that expanded as prices moved up. I won't parse out the specifics, but we had a great growth quarter in units. Obviously, the inflationary environment. We had the execution towards, for example, high-end in gaming and consumer. We had high price bands in commercial PCs. And don't forget the attached business. The attached business for us around peripherals and around services is very healthy. And when the base business grows, it drags more revenue with each and every unit. On servers, absolute server unit growth occurred. They'll probably kick me under the table here. We had significant unit growth in traditional servers. And then we had the content growth. We are continuing to see on a year-over-year basis more cores, more DRAM, more NAND placed in each and every server. So you have the uplift of more content, and then obviously that content is growing as well in terms of the inflationary side. So absolute growth in units, absolute growth in the content driven by modernization and consolidation as customers are looking to upgrade and modernize their fleets. And then we had the inflationary part. The other part of servers that I think is important to call out is this notion of AI drag and seeing traditional servers move and take on AI workloads. Those AI workloads we're seeing with very dense servers making their way into the neoclouds, into some of the more advanced enterprise users, think semiconductor companies, big tech, that are using it to